Why gold can drop when the next crisis begins. Right now, somewhere in a boardroom, a man is being told his safest asset just fell, not despite the crisis, but because of it. He bought gold to protect himself. He was told it never fails. He was wrong, because when the panic finally comes, gold does not always rise. Sometimes it falls first. And by the time most people understand why, their money's already gone. What if everything you believe about a financial collapse is backwards? Stay with us, because the answer to what breaks first might not be the banks, might not be the dollar. It might be the one asset you trusted the most. Welcome back, my friend, to Next Alert, the place where we sit down together and make sense of what's really happening with our money before the rest of the world catches up. If you're joining us for the first time today, do an old friend a favor. Press that subscribe button. Think of it like keeping a good neighbor close by, someone who will knock on your door and warn you before the storm hits, not after. That's all we ask. And tell us in the comments below, where are you watching from today? We'd love to know who's sitting with us on the other side of this screen. Now, let's get into it. For decades, gold has carried a single, unshakable reputation. When the world panics, gold rises. When banks wobble, gold rises. When governments print money without restraint, gold rises. This is the story investors have been told for generations, and it has become something close to gospel in financial circles. But history tells a very different story, one that most gold holders have never been warned about. In 2008, as the global financial system came apart at the seams, gold did not immediately soar. It dropped, sharply. At the exact moment investors expected it to serve as their shelter, it instead became a source of cash. The same pattern repeated itself in early 2020, when markets across the world seized up in panic. Gold, the supposed ultimate safe haven, fell alongside stocks, bonds, and nearly every other asset class. This is the paradox at the heart of every financial crisis. The asset, built to protect wealth, is often the first one sacrificed to save it. The explanation lies not in fear itself, but in liquidity. When a crisis begins, investors and institutions holding leveraged positions face something far more urgent than uncertainty. They face margin calls. Losses on other assets must be covered immediately, in cash, not in sentiment. And what is the easiest asset to sell quickly, without a discount, without a fire sale stigma? Gold. Precisely because it is liquid and trusted, it becomes the first thing sold when the walls start closing in. This creates a brutal irony. Gold rises when people merely worry about a crisis, but gold can fall the moment that crisis actually arrives. Because worry turns into forced action, and forced action means liquidation of the safest assets first, not the riskiest ones. This single distinction separates those who understand market mechanics from those who simply follow tradition. It is the difference between owning gold as a symbol of safety and understanding gold as a financial instrument that behaves according to liquidity pressure, correlation shifts, and the desperate mathematics of margin calls. For the modern entrepreneur, the business owner, the person building wealth deliberately rather than accidentally, this distinction is not academic. It is existential. A portfolio built on the assumption that gold will always behave as a hedge is a portfolio built on an incomplete theory, one that has already failed twice in living memory in 2008 and in 2020. The question then is not whether gold protects wealth. It sometimes does. The real question is when. Is gold a hedge against the crisis itself, or only against what comes after it? The money creation, the bailouts, the currency debasement that follows once the initial panic has passed. To answer that, the story must go beneath the surface of gold prices entirely, into the mechanism most investors never examine, the private debt cycle quietly building beneath the modern economy. Every financial headline points to the same villain. Government debt. Trillions owed, deficits spiraling, national balance sheets stretched thinner every year. It is the number politicians argue about, the figure economists debate on television, the statistic that dominates public anxiety about the future. And yet, according to the pattern that has preceded every major economic collapse in modern history, this is the wrong number to watch entirely. The real driver of financial catastrophe has never been what governments owe. It is what businesses and households owe to banks. This distinction sounds technical, almost bureaucratic, until its consequences are understood. A government that borrows in its own currency does not face the same constraints as a company or a family. It cannot simply run out of money the way a household can. A business, however, can. A household can. When private debt becomes unsustainable, there's no central bank standing behind the family struggling to make a mortgage payment, no institutional backstop for the small business, unable to refinance its loans. Private debt carries a danger that public debt structurally does not. History draws this line with unsettling clarity. Before the Great Depression, private debt as a share of the economy climbed to levels never seen before, reaching a peak that would take over a decade of economic devastation to unwind. During the years that followed, that private debt burden collapsed by roughly 2/3, dragging the entire economy through its most painful contraction in modern memory. After the 2008 financial crisis, a similar deleveraging began. Households cut back, debt-to-income ratios fell. Commentators declared the danger over, the lesson learned, the system safer. But the numbers tell a different story. Private debt today remains far closer to its pre-crisis peak than most people realize. The deleveraging never went far enough to remove the underlying fragility. The system did not heal. It merely stabilized at a dangerously elevated altitude. Why does this matter more than government debt? Because of how money itself enters the economy. When a bank issues a loan, it does not transfer existing money from one account to another, as most people assume. It creates new money entirely, matched by an equal and opposite debt obligation. This is not a theory. It is standard accounting, visible in the balance sheet of every bank in the world. Credit expansion is money creation, and money creation, in turn, is what fuels economic activity. This is why private credit growth correlates far more tightly with employment than almost any other economic indicator. When lending accelerates, businesses hire, wages rise, unemployment falls. When lending contracts, the reverse happens with startling speed. Government spending, by contrast, tends to react to this cycle rather than drive it, arriving as a stabilizing force only after private credit has already begun to falter. For the entrepreneur and the business owner, this reframes the entire question of economic risk. The business cycle is not, at its core, a story about interest rates or political decisions in Washington. It is a story about credit availability. Long before headlines confirm a recession, the earliest and most reliable warning appears in something far less visible: the willingness of banks to keep lending and the capacity of businesses to keep borrowing without breaking under the weight of what they already owe. This is the quiet mechanism sitting beneath every gold price movement, every stock market swing, every headline about crisis and recovery. It does not make itself known through dramatic announcements. It reveals itself gradually, in credit spreads widening, in refinancing costs climbing, in the slow tightening of lending standards that most business owners notice only when it is already too late to adapt. And in the current cycle, a new and unprecedented source of private borrowing has emerged, one large enough to reshape this entire dynamic on its own. It is being built, financed, and leveraged at extraordinary speed, in the race to dominate a technology promising to transform the modern economy. Its name is artificial intelligence, and the debt behind it is only beginning to surface. Every era produces its own defining obsession. The industry so promising, so transformative, that caution itself begins to feel irrational. In the 19th century, it was the railways, when investors poured fortunes into tracks that would never carry a single profitable train. In the early 2000s, it was the internet, when companies with no revenue commanded valuations reserved for empires. Today, that obsession has a new name, and it is being financed at a scale the world has rarely witnessed. Artificial intelligence has become the industry no company can afford to ignore, and no lender can seem to resist. Hundreds of billions of dollars have flowed into data centers, processing infrastructure, and the physical backbone required to power this technology. Initially, this expansion was funded conservatively, drawn from the enormous cash reserves accumulated by the world's largest technology firms. That phase has already ended. What began as spending from surplus has quietly transformed into spending on credit. This shift matters more than it appears to on the surface. When a company spends its own reserves, the risk is contained within its own balance sheet. When a company borrows to fund the same ambition, the risk extends outward, into bondholders, lenders, and the broader financial system itself. The moment debt replaces cash as the primary fuel for expansion, a speculative boom stops being a private bet and becomes a systemic exposure. The bond market has already begun to whisper what few are willing to say aloud. Debt issued to finance data center construction, even when rated at the highest tiers of investment grade, has been pricing at yields meaningfully above comparable government borrowing, and in some cases, above debt considered far riskier. This is not noise. It is the market's quiet, half-formed recognition that something about this expansion carries more danger than official ratings admit. Yet capital continues to pour in. Issuance records have been broken month after month, and every new offering has been absorbed without hesitation. This is where history becomes an essential guide, rather than a mere curiosity. Financial markets do not price risk accurately in real time. They underreact to danger during the early stages of a boom, carried forward by momentum and the fear of missing an inevitable future. Then, often without warning, they overreact once losses become undeniable, unwinding in a fraction of the time it took to build the euphoria in the first place. This is not a flaw in the system. It is the system's defining behavior, documented across every speculative episode, from the railways to the dot-com collapse. There's a second danger unique to this cycle, one that separates it from previous infrastructure bubbles. Physical assets like housing hold their value across decades, even generations. because their usefulness rarely disappears. A data center does not enjoy that same luxury. The processing hardware at its core becomes technologically outdated within a matter of years, not decades. This means the enormous capital poured into today's AI infrastructure carries a depreciation clock that most investors are not pricing in. When that hardware needs replacing, the revenue it generates must justify the cost of renewal. If the economics of that renewal fail to materialize, the asset does not gracefully age. It becomes obsolete, stranded, and in the harshest scenarios, worthless. This is the quiet mathematics few are discussing publicly. Enormous sums have been committed based on the assumption that demand for this technology will justify its cost indefinitely. But early evidence suggests a widening gap between the revenue this technology currently generates and the capital expenditure required to sustain it. When that gap becomes impossible to ignore, the companies carrying the heaviest debt loads will not simply slow down. They will be forced to retreat, refinance under worsening conditions, or default entirely. For the modern entrepreneur, this is not a distant abstraction playing out in corporate boardrooms. It is a preview of how liquidity can evaporate from an entire sector almost overnight, taking down suppliers, employees, and adjacent industries that assume the boom would continue indefinitely. Every speculative bubble in history has ended the same way, not because the underlying technology was worthless, but because the debt built around it outran the reality it was meant to support. And when that unraveling begins, its consequences will not remain isolated within the technology sector. They will travel directly into the banking system, testing the very cushion designed to absorb exactly this kind of shock. There's a moment in every financial collapse that textbooks rarely capture with honesty. It is not the moment of panic. It is the moment after panic, when everyone has already decided to do the same thing at the same time, and in doing so, makes the crisis far worse than any single decision could have caused alone. This moment has a name: debt deflation. It was first identified in the aftermath of the Great Depression, when economists tried to explain a phenomenon that seemed impossible on its surface. Households and businesses were aggressively paying down their debts, doing exactly what conventional wisdom said they should do to protect themselves. And yet the crisis deepened. The debt burden, measured against the size of the economy, actually grew larger, not smaller, even as people worked frantically to shrink it. The explanation lies in a brutal feedback loop. When one struggling business lowers its prices to survive, it does not solve its problem. It exports that problem to its competitors, who must lower their prices in response, simply to keep customers walking through the door. Multiply this across thousands of businesses attempting to liquidate assets and reduce debt simultaneously, and the result is a collapse in prices that outpaces the reduction in debt itself. Debts fall by 10%. The economy shrinks by 20%. The ratio between what is owed and what the economy can generate to repay it does not improve. It deteriorates. This is the trap that swallows even the most disciplined participants. A business that never overextended itself, a family that paid every bill on time for 15 years, can still be pulled under, not because of their own decisions, but because the value of everything around them is collapsing faster than their obligations. Prudence offers protection, but it does not offer immunity. When an entire system delivers at once, individual discipline becomes almost irrelevant against the weight of collective panic. This is where the banking system's true vulnerability comes into focus. Banks are required, unlike ordinary households, to maintain positive capital at all times. When loans across their portfolio begin failing simultaneously, the losses are absorbed first by this capital cushion, the layer of shareholder equity standing between a functioning institution and outright insolvency. In a debt deflation scenario, this cushion is not tested by isolated defaults. It is tested by a wave of them, arriving from multiple directions within the same narrow window, a scenario official stress tests have historically struggled to model with any real accuracy. Now the story returns finally to where it began: gold. The popular belief holds that gold exists as a shield against exactly this kind of chaos, a store of value immune to the collapsing confidence surrounding it. And in one specific sense, this is true. Gold performs well precisely when trust in the financial system itself begins to erode, when investors start questioning whether banks, currencies, and institutions can be relied upon at all. This is gold's genuine strength, and it is not a myth. But this protection is conditional, not automatic. Gold is not exempt from the liquidity crisis that debt deflation creates. When leveraged investors face losses they cannot cover, when businesses need cash immediately to survive a shrinking economy, gold becomes a source of that cash, not a refuge from the need for it. This is precisely why gold fell in 2008 and again in early 2020, even as fear gripped every corner of the financial world. The very panic that should have driven gold higher instead forced its liquidation, because panic without liquidity is not protection, it is exposure. This is the distinction that separates informed positioning from blind faith. Gold does not protect against a crisis beginning. It protects against what follows, the response, the money creation. the erosion of currency confidence that typically arrives once the initial liquidation has run its course. Understanding this sequence and understanding where private debt, AI-driven borrowing, and banking capital currently stand within it is what determines whether an investor is caught in the opening chaos or positioned to withstand it. The signals are no longer theoretical. They are visible now in credit spreads and depreciation schedules, in a private debt burden that never fully healed. What remains uncertain is not whether this cycle will turn. It is only a matter of when and who will still be standing when it does.